Okay, welcome to week 9. We're going to cover a few things today. Going to have a quick look at just talk about the project, not look at it actually. New ratios, inventory turns, a couple new terms, free cash flow, and working capital. And then we're going to go back into budgeting, a little more detail. Okay, the project coming up is a set of Excel spreadsheets. Should be in your email inbox, FOL inbox this week. Going to be due Friday night, midnight of week 13. And it's unique to each and every one of you. It's based on the numbers in it are based on your student number itself. The first 5 sheets are fairly simple: income statement, balance sheet, cash flow statement, etc. It's designed so that you can actually do the first group and still get 40% of your marks right away. I would suggest starting on that almost instantly as soon as you get it. Just take an hour, okay, and work on it and get the feel for it and progress through the sheets one at a time. There are directions in the front of it, and also there's a data page, a couple of data pages depending on which year it is, and just walk through it step by step. That's the easiest way to approach it. Okay, so accounts payable and the average payables period. Um, Basically a measure of how well we're paying or managing our payables. Typically, when you're in small business, if you're the small business owner, you do one thing, and that is the invoices come in, somebody approves them and says, yes, that work was done, or we got the goods. Could be you, could be one of your helpers. And it goes into a big red file on the top of your desk. And you pay that. You just every Friday morning, pull it out, look at what needs to be paid, make sure you got the money after payroll has been paid, the rent's been paid, and pay your payables. It is that simple. Enter them into the QuickBooks or whatever it is, and away you go. That is the simplest and easiest way to manage your payables. Now, if you're really cash conscious and things are tight, then you might have to set up an actual schedule and go from there. The cash budget, of course, helps you with those sort of things. But typically, it's a good thing, a good, nice, simple way to manage your payables is simply pay them almost as soon as you get them. Other than that, then take 30 days. Again, a simple file on top of your desk can work really well. Okay, and accounts receivable, a little more complicated. If you've got more than 5 or 6 customers that are using you for getting their goodies or their services on account, then you really do need to computerize these as they happen and generate the invoices and generate an accounts receivable printout. Okay, so accounts receivable divided by average daily credit sales, and I think we went over that last week well enough. And recall that if your terms are 30 days, then on average your accounts receivable are going to come in at on average about 45 days. That's why many companies have shaved their terms down to 25 days. I know my credit card, when I get my credit card statement, one of them is actually 21 days. Um, so that's the sort of thing you have to think about. And for small business, I've been advocating actually for the last few years for my clients to knock it down to 15 days, or even better yet, get paid by credit card or debit card. We cover more of that in the receivables module. But again, just be aware of how it's calculated from the income statement and the balance sheet, and go from there. Okay, just a reminder, the big thing with the big trick with this, if we're not actually getting paid for 45 days on average, that means we're getting our goodies about 2 months later. This is really huge in that we really have to be careful and predict our cash requirements, especially if we have any sort of seasonality to our sales, okay, because we're going to have a time lag before we get our money in the door. And a bit of a definitions reminder, receivables are generated by revenues that aren't paid for right away. So somebody leaves the store with your goodies, either they're shoplifting or they're a receivable. So that's the sort of thing we have to worry about. Payables are generated by expenses that we don't immediately pay for. So if we get some work done and pay for it later on, or we buy something, quote unquote, buy something, and we pay for it later on, then that of course is a payable. And just as a final note, that means that the cash flow doesn't actually match the booking or the entering into the books of the entries themselves of the purchases and the sales. Okay, and our other ratio for today is inventory turns. I always wrestle whether or not to include this in the course. It is one of those ratios that's kind of important, but it's kind of important for a couple of different reasons. They relate to the strategy of the company and to the pricing of the goods. So we'll talk a bit about that anyway. Okay, so when we talk about inventory turns, we're talking about the cost of sales for the year, the entire year. So how much goodies we bought, not including labor, and just see what that number is, divided by our average inventory. Okay, divided by our average inventory. So usually that's in the simplest form, beginning inventory and ending inventory divided by 2. Now, every once in a while it comes out that we've only got one financial statement. We don't have the last year's and the year before. And so we use the ending inventory divided by 1, which means we use the ending inventory. Okay, some companies actually do a monthly inventory, so you would add them all up and divide by 12, kind of simple averaging. And as well, we might not have the inventory numbers. We might just have the income statement, so we can use the purchases expense as an estimation as well. Can't do it very easily for a service business. Now, we can if we take and say, okay, we've got a bunch of accountants and they're available for 40 hours a week on average over the year. And we can do that sort of calculation and take the hours available as the inventory. That's actually how some things are done like that for service businesses. We're going to leave that alone. I just want to emphasize that the ratio does exist and it does have some sort of importance. And it is really a thing for managers in that they really want to see how well they're turning over their goodies, how well things are selling. Okay, so the idea with inventory turns, usually companies with low gross margins, okay, so if they're selling below what we would normally expect, and I would think 35% for just about any business is a good gross margin, depending on the industry you're in. If you're selling, for instance, at 10%, which I can't imagine why, but happens, usually those companies are competing on lower pricing. So they try to make up the profits by selling lots and lots of goodies at a lower margin, lower profit per item. Okay. To do that, you really need to have a very unique product, in which case I don't know why you're competing on price, and something that's very popular. So there's lots of you. The idea is to sell more than the next guy, have more market share than the next company. We see this, of course, quite a bit in big companies like Walmart, who try and have 12 to 24 inventory turns. So important to note here that the inventory itself, for instance, you might have in your inventory 4 or 5 hammers that actually sit there all year round and don't actually sell. Now that's a bad situation, but what we're talking about when we talk about inventory turns is not the actual individual pieces. Okay, it's the actual dollar amount that we sell that is counted as inventory. So we might have a few items that actually physically sit there. So we might not physically go through all the hammers 12 times a year. But overall, we would go through all of our inventory in terms of value in 12 times. And we see the 12 times number magically appear, especially in retail situations, where companies are trying to sell the fall season, the Christmas season, the winter season. Sports stores are the biggest example of this, where they're trying to sell a different sport every season of the year. And if they're not hitting 12 inventory turns, probably not doing that well. Other companies that sell fast-moving retail goods like clothing and groceries and that sort of thing, they want to see a higher number, 24, 30, whatever the case may be. And they're trying to really fire out that inventory as fast as they can so they can make up the dollar amount on the volume. Just as another note, low price, high turns is not usually a good strategy for a small company. So just keep that in mind. Okay, so usually companies with higher gross margins will have fewer turns because they're not competing on price. They've got some sort of a unique differentiation or competitive advantage. Typically, this is how small businesses compete. Um, Also, don't forget the stale inventory doesn't sell too well. And possibly if the inventory turns are pretty low, not maybe just they're not competing well, but maybe they haven't got a product that's selling. Okay, maybe it's a product or service that nobody wants anymore. So I have to be careful saying it's all about price because typically in a small business it isn't. However, there are industry standards just about everywhere, and we'll get into benchmarking later in the course, where these sort of things are important. And if you're not meeting the benchmark at all or even close, then you have to ask yourself why.